Navigating global waters. The impact of trade policy changes on multinational corporation profitability. Introduction. In the interconnected world of global commerce, multinational corporations, MNCs, operate as economic juggernauts, straddling multiple markets and reaping the benefits of international trade. However, the profitability of these corporate behemoths is not immune to the winds of change in trade policies. As governments adjust tariffs, negotiate trade agreements, and enact protectionist measures, the financial landscape for MNCs undergoes a profound transformation. Exploring how changes in trade policies influence the profitability of multinational corporations demands a deep dive into the intricate web of global trade dynamics. Trade policies, shaping the global chessboard. Trade policies, the rules and regulations governing the exchange of goods and services between nations, serve as the invisible hand that guides the flow of international commerce. Tariffs, quotas, and trade agreements are among the instruments wielded by governments to protect domestic industries, foster economic growth, and address geopolitical considerations. The impact of changes in these policies on MNCs is far-reaching, influencing everything from supply chain management to market access and cost structures. Supply chain vulnerabilities. Multinational corporations often orchestrate intricate global supply chains to optimize production costs and enhance efficiency. Changes in trade policies can disrupt this delicate dance, introducing uncertainties and potential vulnerabilities. For instance, an increase in tariffs on imported raw materials or components can elevate production costs, squeezing profit margins for MNCs reliant on cost-effective global supply networks. Consider a tech giant sourcing components from various countries to assemble its flagship product. If trade policies shift, imposing tariffs on key components, the increased cost of production may erode the company's profitability. In response, MNCs may reassess their supply chain strategies, exploring alternatives to mitigate the impact of policy-driven cost fluctuations. Market access and expansion challenges. Trade policies play a pivotal role in determining market access for MNCs. Protectionist measures or trade barriers can impede the free flow of goods and services, limiting the reach of multinational corporations. For instance, if a government imposes stringent import restrictions or raises tariffs, an MNC may encounter obstacles when attempting to penetrate or expand within that market. Imagine an automotive giant aiming to expand its market share in a burgeoning economy. If trade policies evolve to favor domestic competitors through tariff adjustments or regulatory hurdles, the MNC faces headwinds in its quest for market dominance. Changes in trade policies can thus dictate the success or struggles of multinational corporations seeking to capitalize on global growth opportunities. Currency volatility and financial performance. Trade policies are intertwined with currency dynamics, and fluctuations in exchange rates can significantly impact the financial performance of MNCs. A shift in trade policies may trigger currency volatility, exposing multinational corporations to exchange rate risks that influence revenue and profit repatriation. For example, if a government implements trade policies that lead to a depreciating local currency, an MNC may experience reduced profitability when converting foreign earnings back to its home currency. This currency risk underscores the importance of MNCs implementing effective hedging strategies to navigate the uncertainties spawned by changes in trade policies and their ripple effects on exchange rates. Strategic adaptation and risk management. Multinational corporations, adept at navigating the complexities of global business, must remain vigilant in the face of evolving trade policies. Strategic adaptation becomes paramount as MNCs pivot to align with the prevailing trade landscape. Proactive risk management strategies, including scenario planning, diversification of suppliers, and engagement in dialogue with policymakers, allow MNCs to fortify their positions against potential disruptions. For instance, an apparel company with a diverse global supply chain may strategically redistribute its manufacturing facilities in response to changing trade policies. By optimizing its production footprint, the company hedges against supply chain disruptions, adapts to new policy environments, and maintains its profitability amidst a shifting global trade paradigm. Global trade alliances and collaborative strategies. While changes in trade policies may introduce challenges, they also create opportunities for multinational corporations to leverage global trade alliances and collaborative strategies. Trade agreements between nations can facilitate smoother cross-border transactions, reduce tariffs, and foster a conducive environment for international business. Consider a consortium of MNCs operating in the renewable energy sector. If governments collectively embrace policies that incentivize clean energy initiatives and establish favorable trade agreements, these corporations stand to benefit from increased market access and reduced regulatory hurdles. Collaboration with governments and industry peers to advocate for favorable trade policies becomes a strategic imperative for MNCs navigating the evolving global economic landscape. Conclusion. In the ever-evolving theater of global commerce, changes in trade policies emerge as a potent force shaping the profitability of multinational corporations. The interconnectedness of economies and the intricate dance of supply chains underscore the need for MNCs to vigilantly monitor and adapt to shifts in trade dynamics. While challenges may arise, nimble strategic responses, proactive risk management, and collaborative endeavors position multinational corporations to not only weather the storm but also thrive in the face of a dynamic and unpredictable global trade environment. As trade policies continue to evolve, the profitability of MNCs hinges on their ability to navigate the complexities of international commerce with resilience, foresight, and strategic acumen.